Look, thanks for coming, everybody. Nice to see all the faces here. If you can turn on your cameras, please do. I'd like to introduce David Rowat, who I met because David was in the first CDL West cohort 5 years ago when he was with the company called
5 years
Plural.
ago.
Was it 5 years ago? Yeah.
Wow.
Yeah. You haven't aged a day, David. And he was with the company Plurilock, a very cool data security company. We've kept in touch. He spoke about virtual organizations in my company, in our class last year, virtual companies, and has since done some pretty cool things. So David prefers to run through his entire presentation and make questions at the end. So if you can take notes and we'll have a Q&A period at the end. With that, Mr. Rowat, please.
Great, Daryl. Well, thank you very much for inviting me, and it's a pleasure to be presenting to your class again. So I'm going to talk this morning about virtual companies and some peculiar aspects about them, in that they sell for more money, and that when they do sell, the founders tend to make more money than if they were in a bricks and mortars company. So a little bit about me to start with. I'm an engineer by training. I got my bachelor's at Waterloo, and I did my master's right here at UBC. And then I went to the dark side for a while and did my MBA at the Harvard Business School. But it was always with the intent of learning more about how to help young early stage technology companies in Canada grow. And so I've spent my entire career working with early stage tech companies. I've had 30 years of experience at the C-level with all kinds of technology companies. I've worked for over 70 of them in my career in various C-level positions, or as an employee or as a consultant, all kinds of things. It's been an interesting ride, not the one that I thought I was going to be on when I started, but it's been fun and exciting nevertheless. Currently, I'm a partner in Strategic Exits Corp. It's a boutique investment bank comprised solely of high-tech veterans. And our entire goal in life is to help high-tech entrepreneurs sell their companies for as much money as possible. And it was in the connection of that work that I became familiar with virtual companies, which led to the research that I'm going to talk about this morning. So I'd like to start by looking backwards. And Daryl mentioned that I presented to this class almost exactly a year ago. And it was a different world back then. You know, people drove to the office to go to work, and students attended classes on campus, and remote work was a thing, but it was basically in the background. It wasn't as prominent as it is today. Virtual companies were very rare. They were just starting to make an appearance. And for tech companies, their growth was dependent primarily on their ability to raise external financing. But now the world has permanently changed. I don't need to tell any of you that, but I think when they look back on the 21st century sometime from now, that they will note that the 21st century can be divided into two distinct halves, or not halves, but portions. The 2000 to 2019, which was the pre-pandemic, and then once the pandemic hit, 2020 to the future is post-pandemic. And everything is different now. The work patterns, the social interactions, education, healthcare, communications, every aspect of work and life has been permanently changed by the onset of the pandemic. When we get back to normal, it will be a very much a new normal. It won't be what we knew before. But one thing has not changed in that entire time is that no one other than us at Strategic Exits are looking at the impact of mergers and acquisitions in the tech industry, what the pandemic has brought. So over the past year, as Daryl has alluded to, we've done some interesting research. I organized a collaboration amongst Strategic Exits and professors at the Harvard Business School, my old alma mater, and right here at the University of British Columbia. Many of you may know Dr. Jan Bena, who's a professor at the Sauder School in entrepreneurial finance. He was our collaborator here at the UBC. And between the three of us, I led the research and was the primary author of a new HBS case study, eXp Realty and the Virbela platform, which I understand from the business school is about to be published and available for people to review. And we can't wait to get our hands on it. It'll be very interesting. The first class using that case will be taught at Harvard at the end of February. And the case is about eXp Realty and the Virbela platform. eXp Realty is an American a real estate brokerage, which has 40,000 agents and growing at about 1,000 agents a month, and 800 head office staff, all of whom work remotely. There's no head office, they're all online. And as we'll talk a little bit about later, what the eXp Realty case showed was the competitive and financial advantages of the virtual structure in a very meaningful way. And to that end, for those that are more interested in virtual companies and their advantages, you can go to my LinkedIn profile shown there, and you'll see a host of articles that I've written over the past year on various aspects of virtual companies and why they sell for more, and why the founders make some more money. So let me just set the stage. I think probably most of you were familiar with virtual companies, but just to make us all on the same page, a virtual company is one where all the employees are remote. The company exists only online. Excuse me, there is, sorry, there is no physical head office. And as a result, virtual companies have no leases and very small investments in fixed assets. They tend to be very agile companies. And because they're online, there are no geographic restrictions. They can look for people to join their team all around the world, and many of them that they can acquire and work for the company at a fraction of the price that they would pay here in BC or in the Silicon Valley. One of the most captivating aspects of virtual companies is that there's no commuting, which allows the people that work there to structure a better work-life balance for themselves and for their families. It's one of the great advantages of working remotely. And as a result, virtual companies tend to attract the best worldwide talent who love the flexibility of working when they want to, and spending time with their family when they can, and the ability to work with world-class experts in their field. One thing that's become apparent is that virtual companies are capital efficient. Because they have a lower expense burdens, they're easier to bootstrap and less expensive to scale. And this has two important ramifications for virtual companies. For one, the founders are spending less time financing because there's less money they have to raise, so they're spending more time on the business, which is a good thing. And very importantly, and why I've highlighted it here, the fact that they're raising less money means that there's less dilution for the founders, and this has a profound impact on how much money they get to take home at the end of the day. So we've learned some things over the past year. I remember, Daryl, when we were looking at virtual companies a year ago, a lot of what we were looking at with respect to characteristics of virtual companies were still sort of in the academic sphere. They had yet to be proven. But a lot of the things we talked about a year ago has in fact have come to pass pretty much exactly as we said they would. We noticed that large office-centric companies, big enterprise companies, were all of a sudden were forced to start working from home literally overnight. And overnight, they had to unlearn the office protocols that had been baked into their systems for decades, and to throw all of that out and to learn virtual methods of how to manage when you can't see your people, when they're all online. It was a very different way of working for them, and fair to say that many of them struggled with it. If you look at the articles that have been printed in the press starting about the lockdown last March and continuing on into the present, a lot of it focuses around the organizational behavior of big companies trying to act virtually. It's been a real tough road to hoe. But what's been interesting, of course, and highly predictable is that the employees have really embraced remote work. They like the idea of not having to spend 2 hours in their car every day and work to a work schedule when their families need them at different times. So what we're seeing is that even when we get back to whatever our new normal will be, is that many employees want to stay remote, at least part-time, if not full-time, because of the tremendous advantages. And we can see the tension starting to grow with companies that want them to come back to the office and employees that want to stay at home. But that's not affecting tech companies too much. The tech companies of all sizes are embracing remote work. And for many startups that start remotely or start virtually right from the very beginning, it's very much a key to their identity. So there's a whole culture that's developing around virtual companies within the high-tech sector. So what 2020 has taught us is that it's much easier to start and scale a virtual company, that the transition to virtual work for large office-centric companies is hard. And what this means is that there are whole industries out there that are ripe for disruption. ones that can't move into the new realm, that are more slower to change and to evolve, and small virtual companies that can move on a dime and scale very quickly and very cheaply. These are companies that are likely to disrupt the mainstream of business over the next several years. So if you think the pace of change is fast now, you ain't seen nothing yet. I think we're going to be seeing rapid change over the next decade. And it's a paradigm shift, clearly, in how businesses and people will operate. Resistance is futile, to quote Star Trek. Remote work and virtual companies are here to stay. So now let's talk a little bit about some of the financial aspects of exits and virtual companies. So an exit is a very happy day for the founders of the company, who get to sell their company to a buyer, and they in turn get lots of money put in their pockets as a result. The buyer's very happy because they've got a new cohort of companies that they can bring into their fold, and new technologies which fits into their platform. They're very happy too, and that's how great deals are made, where the needs of both sides are satisfied. But then the government comes along, and that's not quite so happy, because they have an amazing ability to tax wealth wherever it's created. And exits are a great place for governments to collect taxes of all kinds: capital gains taxes, dividend taxes, withholding taxes sometimes if the acquisition is cross-border. And the sum of those can be somewhere between 20 and 40% of the entire size of the deal. So in many cases, the government is the biggest winner when it comes to a tech company exit. But the good news is, for virtual companies, is that they can optimize their tax bill. Because they're online, they can register anywhere in the world they want to. So oftentimes they will pick to register for tax purposes in a country with lower transaction taxes. And that way they can make considerable savings on the size of their tax bill. But that tax planning does come at a cost, because international tax strategy is complex. Anytime that you cross a border, when you are doing an exit to transaction, it gets significantly more complex, because the tax rules are different in different countries. And very few tax and mergers and acquisition lawyers understand the tax law in a foreign jurisdiction. I don't know if any of you have seen the Income Tax Act. My daughter's just finishing off her law degree at the building just down the road from you. But she brought home the Income Tax Act one day, and it is literally this thick, just for Canada. So it's tough enough for tax lawyers to understand the changing rules in one nation, let alone two. So they tend to focus on the country at hand. And what that means is that when you need the tax input from several different jurisdictions, it's up to the investment bankers, people like me, who are structuring and executing the deal. One of our big jobs is to assemble and coordinate the tax lawyers for each jurisdiction, so that all of the tax rules are respected. And when we do that, the tax lawyers can be incredibly creative in ways to structure a deal that touches and accommodates all of the tax rules in various countries, and results in tremendous tax savings for the founders who are selling their companies. There's another aspect of international M&A that is also important, and we're starting to see that antitrust review is starting to rear its head again, particularly in the United States. It's no secret to any of us that big tech is under scrutiny right now, because they've grown so big that basically they're almost public utilities unto themselves. There's very little competition amongst the biggest companies. They've tended pretty much to gather the entire markets for themselves. And some in the regulators are sensing that that what that's doing is reducing competition. And so they're under, the big tech companies are under a tremendous scrutiny at this point as to how they've got so big and whether it's a good thing for the economy or not. One of the things that they've done to continue to grow is to, of course, acquire dozens and hundreds of small tech companies and fold their technology into their offerings. And so that is considered that it might be anti-competitive to continue that, path. And so there's concern, I guess, in the tech sector around, companies selling to the large companies as to whether that's going to be as easy in the future as it is today. There's also political and security concerns. Certainly, governments are becoming more aware of the leakage of valuable technology to other countries. And some of those countries don't have their best interests at heart. So one of the ways that happens is big companies buying smaller companies in foreign jurisdictions and acquiring their intellectual property as a result. So we're starting to see some of these high-profile acquisitions being stopped by governments, and all of which, between the antitrust review and the political and security concerns, means that tech M&A is probably going to get harder, especially cross-border, over the coming years. But again, for virtual companies, there's a way to avoid this. By domiciling in a jurisdiction with fewer regulations, they can sort of bypass all of the scrutiny and review that's happening amongst the industrialized countries and carry on business pretty much as normal. So a tremendous advantage of being a virtual company in terms of tax savings and the ability to avoid a lot of the regulations that get in the way of business. Now, I've mentioned that virtual companies exits tend to make founders richer. And I'm going to take the next section of this presentation to talk about why virtual companies sell for more money and why the founders make more money. I'll introduce the founders wealth creation formula, which Daryl, I don't think you've seen this before. We didn't have it last year. It's something we've developed over the 2020. And I'll finish off with a case study of a virtual company that Strategic Exits sold a little while ago that demonstrates some of the aspects of what we're talking about this morning. So let me talk about the founder's wealth creation formula. And we start off by noting that an exit is a very big deal for the founders of any kind of tech company, including a virtual company. It's typically going to be the single biggest financial transaction that they ever do in their lives, unless they happen to be serial entrepreneurs and are skilled enough to do it a number of times. But for most entrepreneurs, their big opportunity to make the money that's going to set them up financially with their families for the rest of their lives comes when they sell their company. So it's something that's extremely important. So the formula that we've developed calculates how much money the founders can make from an exit. And the way it works is that we start with the gross proceeds of the exit that are paid by the acquirer to buy the company. Then we identify and quantify the amounts that are paid to investors, taxes, and the cost of transaction, the exit costs, and then compare the net proceeds that are left after you've paid off everybody else. Compare the net proceeds to the founders with the proceeds that a conventional bricks and mortar company founders would earn from their exit. And the differences are startling. So this is where we get into some mathematics and some aspects of how exits proceed and how M&A business is conducted. So let's start off first with the gross proceeds that a buyer pays. So when a company is looking to acquire another company, they need to find a way to value it. And typically the way it's done in the tech industry is to look at the normalized EBITDA. And hands up, does everybody know what an EBITDA is? Okay, I didn't see everybody raising their hand, but should I assume that you all know, or should I spend some time explaining it? Just
It's fine, David. Everyone will know what EBITDA.
Everybody knows what EBITDA is?
Okay. I think people are just mostly lazy about raising their hands.
Maybe everyone needs another cup of coffee to get going. Okay, so the gross proceeds are normalized EBITDA times a multiple. Normalizing the EBITDA is to tune up the calculation that the seller produces to make it the numbers look as if the buyer were running the business. So typically you take out any one-time events that aren't going to be repeated in the future, or any revenues or costs that aren't part of the business that the buyer is acquiring. So that requires some adjustment, often with the help of professional accountants to quantify it properly. But the more interesting aspect around this is the multiple that is applied to the normalized EBITDA. And this is where art and science tend to interact, because there's a lot of quantitative but also qualitative factors that go into determining what the multiple is. So primarily it's based on the growth rate, which is kind of obvious that the faster your company is growing, the more a buyer is going to pay for it, because the more money they're going to make with it in the succeeding years. But there's a lot of other aspects to it that affect the multiple. There's many different adjustments that are in the mind of the buyer. One of the biggest ones is the current sentiment for mergers and acquisitions. Right now, as we speak, there's a tremendously buoyant market for M&A, particularly in the tech sector. The markets are at an all-time high. The central banks are continuing to print money to force liquidity in the system to keep the economy growing. And as a result, there's lots of money out there for acquisitions and a healthy appetite to go and buy them. Now, compare that to where we were, 10 months ago when the pandemic hit. Markets dropped off instantly 30%, and the M&A market just closed up tight. I mean, you could not get a deal done in March of last year for love nor money. The sentiments changed that quickly. But as time went on through 2020, the worst of the pandemic passed. The markets loosened up with lots of liquidity. Now we're in a buoyant market again. So it's a very tenuous thing, market sentiment, and sometimes your timing is more dependent upon the sentiment in the market than it is over the state of your business. But again, that kind of sentiment will affect the multiple and what buyers will pay for your company. The predictability of revenue and earnings is important. And this is where software as a service companies have a tremendous advantage, is because they lock their customers into a monthly or annual payment programs, so that a buyer of the SaaS company is very confident about what the revenues and the expenses in that company are going to be, and with less uncertainty, less risk, of course, they'll pay a higher price for it. The buyer will look at the team that they're buying. Are they talented and agile? Can they adapt quickly to changing circumstances? The better the team is, the more the acquirer will pay. Capital efficiency, we talked about a little bit earlier. If it takes less money to produce the next dollar of growth, well, that means that with a smaller amount of money, the company can grow much faster. And of course, the buyer will pay more for it. And lastly, but certainly not least important, is the strategic fit with the buyer. In the tech sector, many acquisitions are done because the buyer has found or sees a strategic fit of the seller's technology in their own portfolio, which they can then leverage to make more money. And so the strategic fit between the buyer and the seller is particularly important, and it will impact on the multiple. The tighter the fit, the more leverage out of the acquisition for the buying company, then the more they will pay for the multiple. So those are the first terms in the founder's wealth creation calculation. The gross proceeds are the EBITDA times the multiple. But now, how is that wealth shared? Let's take a look at several avenues for that money once it's put on the table by the acquirer. First off is that you need to subtract any liquidation preferences that are paid to the venture capital investors. When a venture capitalist invests in a company, they take a portion of the company for the money they invest, but typically they will also put a liquidation preference as part of the deal, and that defines an amount of money that the venture capitalists take off the table before any of the money is shared with anybody else. And it can sneak up on a company founder. If you're selling a unicorn worth $1 billion, then a few million that you pay in a liquidation preference probably doesn't matter that much. But typically, most tech exits are valued somewhere around 15, 20, 30, $50 million, somewhere in that range. So if you're paying liquidation preferences of $3, $5, $10 million from the financing that you've done with venture capital, that can certainly add up and cost the founders plenty in terms of how much money they get to take home. So let me just back that up a bit. So I've highlighted in yellow here that the first thing that's subtracted from the founder's wealth is the liquidation preference paid to the venture capital investors. Now, once that's done, then then the remainder of the wealth that's created by the acquisition is shared amongst all of the shareholders, pro rata to the shareholdings that they have. So the next term is F, which is the percent of the equity held by the founders at exit. That's pretty simple, but we're going to see what an impact F has when we look at the entire calculation as a whole. Next is that you have to pay your taxes, as we talked about earlier. So if T is the tax rate, then 1 minus T is the portion that the founders keep after the government takes their taxes. So we add the 1 minus T into the formula as well. Next and last, of course, is that exit transactions don't happen easily. In fact, you have to pay significant amounts to your professional advisors to execute the transaction. We've talked about mergers and acquisition counsel, which you may have to get different firms on either side of a border if you're doing an international transaction. Tax counsel we've talked about, who do a terrific job, but they are expensive. The accountants who help prepare the the financial statements and the projections into the future. They're expensive. And of course, well, the investment bankers like me, we like to take our piece of the action too for working so hard to close the deal. So the exit costs on a small deal can be significant. And so that's the last term that we put into the equation. So in total, the founder's wealth creation is the EBITDA times the multiple, less the liquidation preferences, all multiplied by the percentage of the equity held by the founders, less the taxes and the exit costs. So the money is shared, in a number of different ways, and the amount of money that the founders create, the wealth that they create, they get to keep a portion of it. But here's the good news for virtual companies, and the thing that became apparent to us at Strategic Exits a few years ago, and that we started to do more formal research on in this past year, is it looks like that for every term that's in the wealth creation formula, virtual companies outperform bricks and mortar companies. The EBITDA is higher for a virtual company. The multiple is higher. There's typically no liquidation preference if they don't have to raise any venture capital. And as a result, the F is higher because they have a higher proportion of the equity that they keep. Taxes can be lower, so 1 minus T is higher. And the exit costs are typically lower because the deal is easier done with a virtual company, well, except for the banker's fees, and they charge typically more because they get to sell the company for more money. So that's a good thing. But let's look at a little bit more closely at why the virtual companies perform better under the various terms in the wealth creation formula. So EBITDA is higher, and we've talked about the fact that virtual companies have lower global compensation costs because they can hire people from any jurisdiction in the world because everybody's online. Very importantly, and this became very important to eXp Realty when we did our study on them, is that there are virtual companies have no facility costs and lower investments in fixed assets and administration. And this can make a huge difference in their expense load and how much money drops to the bottom line when you don't have to pay these costs. Greater operational efficiency. Lean and mean teams comprised of the best people in the world tend to execute very well. So with the same number of people and with a lower investment in compensation costs because they're found around the world, they can actually produce a higher revenue with a less amount of expenses. So overall, with lower expenses, higher revenue, the EBITDA tends to be much higher for virtual companies. So just as a sample, why don't we take and tuck away a number of 50%, representing that virtual companies have 50% higher EBITDA than bricks and mortar companies. So tuck that number away and we'll come back to it in a moment. Why is the multiple higher for virtual companies? Well, again, virtual companies grow faster, so buyers will pay more for them. They have the top global talent in the world, very agile teams. We talked about the fact that virtual companies don't need as much financing, so the founders are less distracted and spending more time on the business. The teams tend to be very dedicated as virtual companies. And what we haven't talked about, but virtual companies are easier to acquire and to integrate into the larger company and to relocate people, essentially because everything is online, so it doesn't need to move very far. So the EBITDA multiple tends to be higher. Why don't we assume a number of 40%? So tuck that number away as well. I've alluded to the fact that the founders keep a bigger percent of the equity. And this is because bricks and mortar companies often have to raise multiple rounds of venture capital financing in order to fund their growth. So in this process, the founders are significantly diluted. And if there's several rounds of venture capital, then those liquidation preferences could add up because each round of financing carries its own liquidation preference value. Virtual companies, on the other hand, can be bootstrapped. So there's less need for financing because there's fewer expenses. So there's less dilution and typically no venture capital investment, so no liquidation preferences. So the founders in a virtual company typically retain a significantly larger proportion of the equity. And why don't we assume that the virtual company keeps 50%, where the bricks and mortar company keeps maybe only 20%? Virtual companies avoid transaction taxes. We've talked about how a bricks and mortar company, or any company really that's domiciled in a country, in an industrialized country with a healthy tax system, they will typically pay 20 to 40% of the transaction price in taxes. Whereas a virtual company, if they can domicile in a tax-friendly zone, can pay slim or no transaction taxes at all. So now you've tucked away all of those numbers. Now let's bring them out and put them into the creation formula and see what the results are. They're quite astonishing. So let's start with a bricks and mortar company that has an EBITDA of 15 million and a multiple of 5. So the gross proceeds are 15 times 5 or 75 million. Now, a comparable virtual company, we've said, would have 50% greater EBITDA and 40% greater multiple. So when you put those into the equation and crank the number, you get a gross proceeds of 158 million, which is twice as much. So just by the very fact of being a virtual company, typically they will sell for, or they could sell for 2 times as much money. But it gets even better for the founders in this scenario. In the bricks and mortar company, looking at the founders and what they get to take home, they retain 20% of the equity. Let's assume they have a liquidation preference of 3 million to pay to the venture capitalists. Their tax rate is 25%. Which is typically what you would pay in North America, and the costs of the professional advisors are about $1 million. So you plug that into the formula, and you come up with a value of about $9.8 million, which is not a bad payday for founders. I mean, that could set them up for life and pay for expensive education for their children. It's a great day for them. But look how much better it is for the founders of a virtual company. They keep 50% of the equity, no liquidation preferences, and if they're offshore, they don't pay any taxes. The exit costs are a little bit higher because the company sells for more, so the bankers get to take home more money. But when you punch all of those into the creation formula, you end up with a value of $75 million, which is what seven and a half times bigger for the virtual company founders than for the bricks and mortar companies founders. It's an astonishing discovery that how much better virtual companies are for founders. Now, we'd be the first to say that these numbers are aggressive, and that's because not every virtual company has all of the advantages that were listed, and many of those advantages are overlapping. For instance, the capability of the team acts both to increase the multiple as well as the EBITDA, so there's a bit of double counting that goes on there. So we should pour a little water into this wine and suggest that it might not be 7 times as great, but we're pretty confident based on the work that we've done with virtual companies over the past few years that the exit price is typically 50 to 150% higher, and that the founders typically earn 100 to 300% more when they sell their companies. So something very much to bear in mind. Now, in the course of our research, we took a look at eXp Realty, and we compared it to Redfin, which was a technology-driven bricks and mortar version of a real estate brokerage company. And we dug deeply into the filings that because these are both public companies, so we were able to get a hold of their financial statements and go back over them for several years and dig deeply into what their financial performance were. And we summarized it in this one slide here, and the results we found were pretty striking. So you look at the year of founding. So eXp has been going since 2010, so they're 10, 11 years out. Redfin has been going 16, 17 years, so they've had 6, 7 more years to grow their company. But look at this, in 2019, which is the full year numbers, the latest full year numbers we have, eXp was able to generate $980 million in revenue, which is significantly more than Redfin, only 780, even though Redfin has been building their business for 6 years longer. And so that translates into the revenue growth. So over the last year, 2018 to 19, eXp grew at 96%. And Redfin at only 60%. 60% is not bad, but obviously if you're doubling every year as eXp is, it's much better. And that has an impact when you look at the profit before tax. Again, because eXp is virtual, it avoids all of the real estate costs that you typically see with a virtual broker or with a brokerage company. They lost $9.5 million in 2019, whereas Redfin lost $81 million. In fact, as we dug back through their financial statements, we discovered that Redfin has never earned money in any year or in any quarter since their founding. They have funded their growth and their operations by multiple rounds of venture capital, and we'll see the impact of that in a minute. So if you looked at the adjusted EBITDA, once you add back all the non-cash charges, the biggest one being the stock-based compensation expense when they hand equity to their employees, eXp turned an EBITDA profit of $13 million, whereas Redfin lost still an astonishing $62 million in this most recent year end. Now, the funny thing is, though, that when you look at the valuations, Redfin has a higher valuation, 4.7 billion, than EXP does at 3.3. And the reason for that has less to do with their financial performance and more to do with their with the trading of their stock. EXP is still very tightly held by the founders, and as a result, institutional investors have not paid much attention to it. So it suffers from a concentration discount. Is that it's not highly traded. It's not highly traded, so they tend to get a discount on their equity. They don't trade as much or for as high a value, and as a result, Redfin has exceeded it in valuation. But I'll make a bold prediction here that I think over the next 2 years that EXP is going to increase its valuation and surpass Redfin, because the research analysts are starting to discover that the secret of EXP and the fact that it has quietly built a huge business, well, everybody's been watching what Redfin's been doing. So we'll check this when we come back, Daryl, in a year's time. We'll update this chart and see if the numbers have flipped over. Look at how much financing has been raised. EXP has raised next to nothing, an initial raise of $750,000. Well, Redfin has raised round after round, totaling over $700 million. And we can see that as a result, the founders of EXP still hold 57% of the company, even after all of this growth, whereas the founders are long gone in Redfin. They don't own anything at all. So I think this real life example tends to demonstrate what our research has shown, that virtual companies are worth more. They sell for more. The founders keep more of the proceeds. Virtual companies grow faster and are more profitable. All the things that we've suggested are borne out in this one example. So the implications for entrepreneurs, I think, are pretty important here. So that if you're a founder about to launch and start a tech company, and if you understood this research and these findings, would you rather start a bricks and mortar company or a virtual company? I think the answer will be borne out over the next several years and decades when we see that many more virtual companies are likely to be formed in the next few years. So let me finish off by talking about the case study of a virtual company that Strategic Exit sold a couple of years ago. It was a data analytics company, and it was founded by a millennial digital nomad. This fellow he had no formal training in software, but he saw an opening in the data analytics field that nobody else was exploiting. So he jumped in there with both feet. But this was a really curious fellow. He was a digital nomad, which meant he had no permanent address. He called himself Airbnb's best customer, and what he would do, he and his wife would fly from country to country every couple of weeks, find an Airbnb, plug in, and manage the company online from wherever they happen to be. So, a classic case of a digital nomad running companies from anywhere around the world. His company was profitable right from the get-go. He bootstrapped it with no external financing at all. And he completed the development of the software and launched his application within a year. And within 3 years, he had grown to 40 employees, all of whom were working virtually from various spots around the globe. And what this company did was provide a case study on how to build a team in a virtual world. He looked for other experienced digital nomads like himself, who he could trust, who had the experience and the ability to act and to move forward without a lot of supervision. Because of course, when you're online, it's it's not much more, but it is more difficult to maintain constant communication lines. So the ability to work without supervision and knowledgeably is very important. He picked the best digital nomads he could find from around the world, and they formed a very cohesive group and built the company on that basis. He only hired the best developers he could find from around the world. If you couldn't show that you could crack great code inside of a week, you were probably gone. So a tough process, but he hired the best people around him, and that's the success is the proof of how fast they were able to grow the company. It was important that everybody that they hired were committed to working virtually. It was part of their identity, something they prided themselves on, and defined them as distinct in the marketplace, something they were very proud of. And so there was a team of very smart, self-starting workers who were responsible, accountable, and required very low oversight to get the job done. Key part of their ability to grow so quickly. And growing quickly, they did. I mean, after 2 years, the founder decided that it was time to sell because the company was growing quickly, it was highly profitable, and he wanted to take some money off the table. So he looked for an investment banker to help sell the company, and he chose strategic exits. And I think for two main reasons. One is that all of us are technology veterans, so that we knew exactly the problems that he was facing because we'd faced them many times before in our own companies. And we were also experienced as we could operate virtually, and we had done several virtual company exits before. So we had the right culture, and we had the right experience, and I think that's why he chose us. So we went to work and looked to find the best buyer for this company from around the world. We probably looked at 100 different companies, and we found several that were extremely interested in the company. And one that was so interested that they made a very attractive preemptive offer, which effectively locked all of the competition out. It was a wonderful day for the founders and for us too. And the acquirer was drawn to our client because they knew the space of data analytics they were in, so they could add some value to the company once they were acquired. They really liked the story of how the founder had bootstrapped the company right from the startup. The team was very strong, and they had by the end of the third year shown a tremendous fast growth and made an immediate impact in a very large market. So they signed a letter of intent to acquire the company and committed to close within 60 days. And if any of you have been involved in a merger or acquisition, I mean, that is quite a barrier to put in place to close in 60 days. Most acquisitions take much longer than that to do. But again, this is part of the advantage of being a virtual company, because the due diligence is much easier than it is typically in a bricks and mortar company. There are fewer records because the company is smaller, leaner, and meaner, and all of them tend to be, well, they all have to be electronic because it's a virtual company. So in this particular case, we were able to assemble and populate the virtual data room and have all of the documents reviewed within just a few days. It's rather remarkable, because in a typical exit transaction, it can take weeks and months to get the diligence done because of the need to find the documents from all around, offices scattered hither and yon. Very difficult to pull the information together and to make sense of it. But with a virtual company, that's pretty much done for you because everything is electronic to begin with. One of the interesting aspects of an exit execution transaction is the site visit. And usually this is the time when the buyer sends their diligence team up to see the target acquiring company. And it's a key moment in the M&A process. Because every conversation and every meeting must be scripted from the time the diligence team gets off the plane until they're on the plane going back home again. So it's a very high tension and a very important part of the process. But how do you do a site visit when there is no site to visit? I mean, everything's electronic. There literally is no head office to visit. So we did the next best thing. We pulled out a map and we plotted where all the employees were working around the world. And we found the city that had the greatest concentration of employees working nearby. And we flew our team and their team, and we holed up in a hotel room for a couple of days to do all of the diligence. But what we discovered was that there was lots of time, informal time over dinners and lunches for the teams to get to know each other. And both sides, I think, will credit these casual conversations to developing a greater understanding of each other's companies. And that was really what cemented the deal going forward. Now, strategic exits was busy too, managing this transaction. We had to do our job to assemble a very strong exit team. We chose the Mergers and Acquisition Council specifically because of their cross-border experience. This was a transaction that touched not 2, but 3 different countries in order to manage and to minimize the taxes. So we hired an international tax strategist and lawyers that were competent in 3 different jurisdictions. So we had a lot of very high-priced talent working on this deal, and it was our job to manage the process and to accelerate it to make sure it would close within 60 days. And we did that. Although the deal was complex and broke new ground, there was a point in time about a week before the scheduled close where I honestly didn't think the team was going to make it, because there were several hundreds of documents that were required. Dozens hadn't even been written, let alone reviewed. But both sides burnt the midnight oil, worked extremely hard, and when the dust cleared, it actually closed the transaction not in 60 days, but in 40 days. It was an incredible accomplishment. So, that's a team that I would work with anytime. Professional, very hardworking, and added value to the transaction in many different ways. So, in this successful sale, we look at a company that was bootstrapped with no investment. It developed and launched their global data analytics application inside of a year. Tremendous achievement. Rapid growth in revenues and profit, which prompted the exit to take place. We successfully sold them in only their third year of operations, and with a transaction value of, wait for it, over 125 million Canadian dollars, which is quite something for a company that's 3 years old and 40 employees. It was a great payday for everybody. And the founders got to take home much more of that money, of course, because there were no venture capitalists involved, and all of the equity was held by the founders at closing. So, a great win for virtual companies as well. So if we look at the takeaways on this one, it was a virtual company, and so it increased the exit price. There was a team that worked hard, so they created tremendous value over the 3 years that the company was in operation, and a world-class team, including the M&A advisors, tax strategists, and lawyers, were able to structure the best exit that they could, and was very successful with a $125 million exit. So in summary, as we said from the beginning, virtual companies sell for more money, and the founders make more money in the transaction. So with that, Daryl, I'll wrap up my part of the presentation. We'll throw it open for questions.
Great, thank you so much. I'll kick off the questions, and while we're waiting for students to raise their hands in Zoom, I'll moderate the Q&A for us. Really liked your story. For this particular case study, early founders were basically working for no salary. They were just working for equity. Is these digital nomads?
Well, as you know, Daryl, that's typically the case when you found a company. There's no money. You're just starting, and so you often have to work for many months for free just to get the first customer or to get the first financing done. In this particular case, this data analytics application they found was able to generate revenue almost from day one. It fit a niche so well that customers could see the value of it instantly and were prepared to pay money to use it straight out of the gate. So unlike many applications where there's a free trial period, there wasn't with this particular company. If you wanted to use it, you paid right from the get-go. If you wanted to cancel later, you could and get your money back, but almost nobody did. So they were actually able to fund themselves right from the get-go. If they worked for free, it wasn't for very, very long.
Great. So in your research, where do virtual companies who want to optimize for these benefits tend to domicile?
They tend to domicile in places which are very tax friendly. They typically don't take capital gains taxes or dividend taxes, and oftentimes they don't take corporate income taxes as well. These are companies that attract offshore investors to come and locate their companies there specifically for these reasons. So, there's any number of lists you can look at of tax-friendly jurisdictions from around the globe. The advantage for virtual companies, as I mentioned earlier, is because they are online, they can, domicile for tax purposes in these jurisdictions without actually having to move there. So they can continue to work, wherever they are, but the company is domiciled offshore.
Got it. So the Cayman Islands, Curacao, Hong Kongs of the world, basically.
I think those were names that you would see amongst others that, would be interesting places to locate a company.
Okay, last question for me, and then we'll go to Nathan Wong, and that is, what are your thoughts, and it's indirectly tied to this conversation, conceptually speaking, what are your thoughts on virtual companies or bricks and mortar companies that have a new virtual environment? And the fact that they want to reduce the pay of virtual workers, whereas, previously they have a premium paid to workers in San Francisco or the Valley because of high rent, and these employees are moving to Kansas City and the Midwest and et cetera. but want to maintain their San Francisco salaries. And there's emerging conflict in this conversation. Have you seen anything like that? And do you have any comments on that?
Yeah, I do. Personally, I haven't seen it up close, but I've certainly read the commentary in the tech journals. Well, this has been a very big topic. So I think it came as a bit of a revelation to many of the companies who are located in Silicon Valley, where they're paying very high rents and they're paying premiums to their employees to work there because the cost of living is so high. Well, all of a sudden the pandemic hits, everybody heads home, and they see all of this expensive empty office space sitting there and not being used. Meanwhile, the company is just as efficient, if not more so, than it was before everybody went home, because everybody's used to working remotely. The people like to live at home too. So I think there's two sides to this equation. I think for many workers, particularly those with family, and I would say particularly with women with families, the ability to schedule their time around their family rather than around their workday is worth millions into them in so many ways, because of the a much less stressful life and a much more fun way to operate. So I believe that in fact there are stories out there, articles in the press, that many employees would actually take a lower salary to be able to work from home and not to have to face that commute every day. And there is a certain percentage that's the case. Now, in the other cases, the companies are saying, wait a minute, if you're moving to Tulsa or to Kansas City, your cost of living is going way down. So we're going to reduce your salary. So I think it's important to distinguish, are they paying premiums that they now no longer have to pay, which is one thing, versus paying a market rate salary that they're now reducing, which I think is, is something slightly different. I can see the argument for companies not paying premium salaries to have their employees come to the office in the Valley when they could just as easily be living and working in a much lower pace. So I can see the premiums disappearing fairly quickly. But to go the next step and actually reduce salaries because enforcing people to live in low-cost jurisdictions so that they can get the same after expenses pay, that's a little bit different. And I think you are seeing a lot of pushback on that.
That's interesting. I guess we'll see some equilibrium pricing in the market as this new trend continues.
Well, I think so. And what they've noticed is the commercial real estate is dropping in value as people are vacating the offices to come and work from home, and real estate prices are starting to move up in the suburbs as people are relocating basically to their bedroom to work. You'll see that in excuse me, in the Lower Mainland is that property values in Maple Ridge are climbing because people have decided that they're going to stay at home rather than hop the West Coast Express.
Yep. Yeah. Condos are flat. Houses are up.
Yep.
Nathan Wong, followed by Philip.
Yeah. Hi. I was just wondering what your thoughts were on growth, specifically in regards to valuation, just in the sense that how much weight should be placed on growth when considering the valuation in the long term, because there's a big focus right now on big growth companies, but they're not actually profitable. So how does that factor into what you're willing to pay to acquire?
So you said valuations, growth versus profitability. Is that?
Yeah, correct.
Yeah, good question. And this is a question not just for virtual companies. This hits every high tech company, right? Do you maximize for profit? To show that you're a profitable company, or do you optimize for growth? And typically, and this is certainly true in virtual companies as well as I think most other companies, you'll pay to grow before you'll pay for earnings, because the growth factor has a significant impact on the valuation. When you're an acquirer, you're looking to buy a company for what it can bring to you to fit inside your technology and your marketplace. As an acquirer, you're looking to get the leverage of the technology applied in your markets, or buying some market share of the acquired company, bringing their revenues into it. But it's the leverage that you get off of bringing them in that's important. So they're typically not buying your profitability. That doesn't matter typically, because they're going to bring your operations inside their company and get the leverage from it. So it's how much money they're going to make after they've acquired you rather than the amount of money that you make before they acquire you, if that makes sense. That they're looking for the fit and the leverage. And so the ability to grow quickly is a much more important factor. And that's why it factors so heavily into the EBITDA multiple.
So then would this also apply to companies that opt to IPO instead of be acquired?
Yes, it would. It would.
Okay, thank you.
Philip.
Hi, David. My
Hi.
question is, from your experience, how do you think that successful founders actually manage hiring employees across borders? I have experienced this, and this can become very quite unwieldy. Do they like choose specific countries to hire people from, or how is that done?
The most important thing in hiring people virtually is their fit with the culture of the company. And so I think it's the jurisdiction probably doesn't matter very much. I mean, there are places like Bangladesh where people, you can pay excellent people a tenth of what you'd pay them in the valley. So I mean, the jurisdiction is important from a cost point of view, but more important than cost is the culture fit and the ability to as we talked about with that sample company. The ability to fit in a culture, to be enthusiastic about working virtually, to be a self-starter, and to work without a lot of supervision. These are the qualities that that the virtual company is looking for in the people that it hires. And because everything's online, the jurisdiction really doesn't matter. You've got a time zone issue, of course. But you can find ways to work around that. You schedule meetings early in the morning or late at night. It's not going to be convenient for everybody on the call, but that's part of the nature of being able to work from a far off location. Is that sometimes you're going to work funny hours. So jurisdiction not really that important, but the fit with the culture extremely important.
What about legislation-wise? That's what has really been the complexity in the past that I have experienced. Whereas depending on the country, you have to follow different regulatory systems to hire people and where they are located, and that can be quite complex for startups.
Yeah, I get your point on that. I ran into that situation the hard way many years ago when we bought a company. The company I was working for, we bought a company in Sweden, and we looked at the salary that we were paying the scientists that we acquired, and they were pretty hefty salaries when translated back into Canadian dollars. But what we did not appreciate was the overhead, the employee benefits, which in Sweden, because it's a socialist country, it amounted to 40% of the gross pay. I mean, it was staggering, much higher than we expected to pay in Canada. We just really weren't prepared for that. So what we learned from that, and I think what's become more obvious as more and more companies go international, is that you have to respect the laws and the customs of the country in which you're working. So if you're hiring somebody in Germany, then you abide by German laws. And Sweden or Bangladesh or Nigeria, England, anywhere you go, you have to abide by the laws in that country. So if there's withholding that has to happen at source, well, then you got to make sure that that's done. Happily, a lot of the payroll companies, are able, they have their software that will work in various different jurisdictions. So the whole source deduction and tax remittance to the governments can be done automatically through the payroll system. So it's not something that you have to spend a lot of time worrying about. So, so if you follow the rules, then everything's fine. Part of it is if you have to terminate somebody. Boy, oh boy, in the United States, employment is at will. So terminating people is as easy as showing them the door. And, there's not much comeback. In Canada, you've got severance laws or, severance rules that you have to abide by. And if, an employee takes a former employer to court because they didn't think their severance was good enough, most of the times the court will side with the employee. If you go to some places in Europe, it's almost impossible to fire people. The cost is so high, and the reserve rights that employees have are so strong. So you need to understand these things, before you embark. and you have to follow the rules that exist in each country in which you deal. Does that answer your question?
Yeah, it does. But I still like don't really understand like how founders would conquer those challenges. Whether they avoid like certain countries, or are there like a specific list, or do they like just really learn that on the streets and use the payroll software to not really have to worry about the everyday sort of expenses? But that's you obviously mentioned other expenses such as the expenses that come from terminating somebody, and that is very time consuming to getting to know those sort of things. um, is there like any specific way, or do they just learn as they go?
I'm not sure I understand precisely your question. Are you looking at how a virtual company avoids some of the challenges of hiring internationally? Is that the issue,
Yeah.
or is it something else?
Yeah, precisely.
Okay, so anytime any company goes to recruit somebody, particularly if you're in a fast growth tech company, the cost of a bad hire is is not just the money that you've lost by having to terminate them, or to pay to make them go away, or the salary that you paid them when you didn't get the value that you thought you were getting. I mean, those are direct out-of-pocket costs that you can measure. But the far greater loss is the loss of momentum. If you've got the wrong person in the job, then it's slowing the whole company down because they're not executing in the way that they need to. And so by the time you figure that out and you make the change, a significant amount of time has been lost in terms of the progress of the company, and that you cannot measure. But know that it's expensive. And so it's incumbent upon the company and all of its people to do an excellent job of hiring. If you have to spend twice as long to hire somebody to make sure that you got the right person, that's the right decision to make. You hire quickly at your own risk, and you repent at leisure is the way it goes. So in order to do your diligence, it's going to require a lot of conversations. And in a normal bricks and mortar company, you'd be sitting across the table from each other in these conversations. In the virtual world, you would be sitting across in a Zoom call or a Skype call like we're having now. So you can ask the same questions and get the same information. It's just it's going to be remotely. Checking references is a particularly valuable thing to do. And I would say that that's easier to do onshore, where you're in a local community. You may know the people that they've worked with. Much harder to do if somebody's 12 time zones around the world where you don't know any of the people that they've worked with. But by skillfully asking the questions and getting the answers, you can get a sense of whether they're the right person for your company, and spend a lot of time hiring. It's interesting. I remember now with EXP. At the time that we were doing our research on that company to write the case study for Harvard, they were just in the process of hiring their chief marketing officer. And the morning that we scheduled our interview, the founders realized that they'd gone through a month of interviews with this candidate, many discussions, and they'd actually never met her in person. They'd never met her in person. All of the hiring at a very senior position, all of the process was done online, which shows you the power of the ability to interact in a face-to-face conversation over Zoom. It's become powerful enough that you can actually take the risk on hiring a senior person without even having to meet them in face-to-face.
Great, Nicole.
Thanks, David, for the great presentation. I have a couple of questions actually. So my first one is, a lot of the OECD countries are now cracking down on tax havens, and with Canada claiming that they're ready to go at it by themselves by 2022. So do you see that potentially implicating some of the tax benefits that you were talking about?
Yes, I do. It's and you're quite right. I think they are cracking down on the tax havens, because it's not just small virtual companies that are tax planning. There's all kinds of people that are taking advantage of it, and some of them are not doing it respecting the law. And that's of a particular irritation to countries and, in fact, citizens of countries who are paying their fair share of taxes and other people aren't. So they are, I think, cracking down on the tax havens. I think you'll see fewer of them in the future, and that makes it harder to do that form of tax planning. So, and I want to make sure that for the record that we distinguish tax planning and tax avoidance from tax evasion. You know, it's perfectly fine to arrange your affairs to minimize the amount of taxes you pay, and that's what we've been talking about this morning. Quite something else to break the law by evading taxes, and certainly we're not, and nobody should be advocating that kind of behavior.
Thank you. I'll just hold off my second question till everyone else is done.
Okay, sounds good. Jackie?
Hi, thank you so much. I'm thinking about kind of the people aspect side again and how the culture works, because I feel like, as you mentioned, speaking together over Zoom is fine, but then the real conversations when you become like friends with your coworkers is the like lunches and coffees and that type of thing. So I'm thinking, if like a company is built by its founders, obviously they're very invested in like making sure it runs well, but all the other employees that are working hard to like make sure everything is possible, if it was like acquired by someone else or anything like that, what is keeping these employees from staying with the company when it's like super easy to just change jobs because you're just switching Zoom accounts or something like that?
Right. Well, there's three points to make in response to that. I mean, that's a very important question, and it speaks to mergers and acquisitions in general, not just in virtual or even in tech companies, but M&A broadly, defined across many industries. But let's talk about virtual companies first and their culture. So I mentioned how important it is that the culture of the person, fit the culture of the company, and that's extremely important when you're, Zoom to Zoom, because you aren't there to have those lunches that help inculcate people into the new environment. So so the hiring is particularly important. Spending lots of time on that, as we talked about. Also, once the person is on board, it's incumbent upon everybody in the company to engage in a higher level of communications than they normally would if it was a bricks and mortar company. So you have to really focus and spend a lot more time communicating over Zoom or Skype or in groups like that, to make sure that everybody feels like they're a part of the team, even though they're remote from the company. So that's very important. The third part is that, as you say, even with the best of Zoom and the best of constant online communications, you still miss that physical component of meeting people. In fact, there are, my wife was the first one to say that she would hate working in a virtual company because she can't stand not being able to talk and see people. And, so for many extroverted people, working in a virtual company isn't for them. And that's what you need to figure out fairly early on. If you go to my blog site, linkedin.com, Rowat, there's an article I wrote on introverted people. And, introverted people do very well in virtual companies because they can actually push everybody to the side and actually get some work done, which is what introverted people love to do. So this is a time for virtual introverts to shine, as in the days of virtual communications. But that all said, the successful virtual companies we've looked at still do a physical meetup, once or twice a year, to bring everybody together in person. Now, during the pandemic, it's not possible. And so, there are the strains and the tensions that you're hearing about, and the people are getting depressed because they're not able to get the same level of human interaction. That's true right around, all industries, all people around the world. It's not just a fact of virtual companies. So, we have to get through the pandemic and get back to some kind of new normal where there's more remote work, more online communication, but also some more physical meetings, to get the full value out of this, to kind of optimize amongst, remote work versus hands-on work and face-to-face work. The last point, you mentioned about, after the acquisition, what happens? Well, research over the last several decades have shown that most mergers and acquisitions don't achieve their objectives. And it's not because the companies don't fit together on paper. On paper, you move the Excel models around and all the numbers add up great and everybody's going to make a huge amount of money. But what they forget is that the culture between the acquired company and the acquiring company tend to be different. And if they don't manage that interface very, very well, then you do find people who say, look, this isn't for me and I'm out of here. So, that is a a requirement or a feature of any kind of mergers and acquisitions across any industry. So the smart companies who do the acquiring, actually focus and have a joining up, a very formal joining up process where they bring people into the fold, they communicate with them, they teach them the culture and give them an opportunity to learn. And so you need to do that in any company, in any acquisition, in any industry, not just high tech and not just virtual companies.
So we're almost out of time. So Arya, I'm going to give you the last question. Jeremy and Nicole, I put contact details for David in the chat in Slack. So if you and anyone else has questions, feel free to reach out to David. Arya, I'll finish with you.
Sure. Thanks, David, for the presentation. So I have had some experiences running like a virtual team in the past year. And I have faced like several problems. The first problem is like, so as Jackie mentioned as well, like if they want to, the only way to communicate with them is via the internet, right? So if they switch their Wi-Fi off, then I have no access. That's one thing. The second problem is like, there's no binding contract. Like there's no way that we can write a binding contract with them. So there's no way to enforce like the contract. So like you're always stressed at like what's going to happen if they're going to leave or not. The third problem is like if I'm living in Canada and if I want to hire someone like virtually from other countries, my first choice would be like a country in Western Europe or Middle East or in Asia, right? I'm not going to hire someone from Europe because it's going to be as expensive. And the working culture in those countries are not as professional as Canada, and that causes a lot of problems. So for me, from the buyer perspective, I would prefer to buy a non-virtual company rather than a virtual company. And as a founder perspective, I kind of feel like if I'm in Canada, I want to hire my team in Canada because like I know even though it's more expensive, but all the funds and like shreds and stuff like that, you can kind of like make up with that. So, and then like, I don't really think like it would be any advantages to hire someone virtually. Even though I'm doing it right now, I'm having like team virtually, but like I'm having this dilemma. So that's why I'm asking the question. So
some context for everyone. Arya is a CDL student from last year, has a couple of startups and, has some traction as well. So David?
Oh yeah, well, Arya, well, congratulations on getting up and running so quickly. That's the entrepreneurial spirit that we all love to see. So you raised a number of questions. Yeah, if the Wi-Fi goes down, then you can't communicate. Well, hopefully you've got a cell phone beside you, and maybe you've got an international plan, so it doesn't put you in the poorhouse. Phoning your employees and halfway around the world. So you need to have an alternate communication system. So. I mean, the internet is becoming almost like a public utility at this point because so much is dependent upon it. But do have a backup so that if you have to get a hold of somebody, you can. I haven't seen fax machines used in probably 10 or 15 years, but time is when that was a major form of communication because it was easy to get a telephone link across across the oceans, and maybe that's a very crude backup plan, but you need to have one. As far as hiring people that where you can enforce a contract, if it's at the point where you're looking at a contractual solution to solving an employee problem, then I think you've already suffered the problem and it's too late. As we talked about a number of times, the joining up process is so important. Spending time, in the front end, hiring the right people who, are bought into your culture and your company and its ways of operation. That's absolutely critical. And if they're leaving after a short period of time, then you got to look at, well, why is it that they're leaving? Is it they found another job that paid more money, or is there something in my operations and the way that we interact that's that needs to be improved? I can't answer that question for you, but that's something you need to find out. Because my experience is, and there's a company I know that's headquartered here in the Lower Mainland, but 50-70% of their development staff is in Bangladesh. And they've had no problems at all. I mean, you know, you walk into their building and you see photos of everybody that works at the company, whether it's in the Lower Mainland or whether it's in Bangladesh. They're all up on the wall and celebrated for their, you know, for their tremendous accomplishments. You know, before the pandemic, they'd be on a plane about every 3 months to go and visit them to make sure that they were, everybody's needs were being taken care of, that they were happy, that there were no problems that were not surfaced. So, you know, being virtual requires a lot more management effort to keep employees happy and on board, for sure. And so if you're losing folks, then, you know, you need to dig deep into find the reasons why. There was a third question you had, Ari, but I can't remember what it was.
It was the work culture.
Mm-hmm.
But like between if you compare the work culture in Canada or in the US with like other countries like in Eastern Europe or Middle East. I'm personally from Iran, so like I can relate to Iran. So like if you compare those countries, you can definitely see the difference between those countries. And like as a buyer's perspective, I kind of want to deal with like a better, more professional culture in the company, right?
You know, I'm frankly surprised to hear that because that runs counter to, you know, to what I've seen. It's typically, and again, on the hiring process, go to a website called remote.io. And this is an outfit that, you know, looks at trends in remote work. And they typically, you know, have a list of the top 25 virtual companies that, you know, that they're interviewing. And you'll see in case after case after case that people are much happier working for this virtual company because of its freedoms and flexibility. And, you know, working remotely is very much part of their culture. And that's what they screen for when they're hiring people at the beginning. And so they don't have any problems with professionalism. You know, people may be working flexibly, but they're still working as hard and producing as much. And their, you know, their reviews are based on what they've accomplished rather than how many hours they spent sitting in a seat. So I think that that's the, you know, the flavor that you need to take into the process. If you're losing, if their people are not professional enough, well, I would suggest that given your ability to hire people remotely from anywhere in the world, that there's a, you know, 4 billion people to choose from. So make sure you choose the right ones. Spend the time in interviewing them and checking their references to make sure that you're getting the commitment that you need.
All right. Well, look.
Thank you so much.
Thanks, Arya, for that. And we're out of time, David. We really appreciate your time today. It's interesting for people who are a certain age, like us, who actually have a conversation called "There's such a thing as a virtual company," and then there's a generation, for the most part, we're speaking to who are like, "Of course, there's a virtual corporation. What are you talking about?" And for those of us who actually work with fax machines, as an example, you know, and telexes. Back in the day. But I really like the thesis that virtual companies can make more money. And if you've operated a company before, it makes a lot of sense because you know all the little costs that add up really a lot when you're bringing in people to your bricks and mortar, when you're onboarding them, when you're basically relocating them, when you're bringing them into different things, you know, and so, you know, you can see how it's an impact on EBITDA. And then the challenges, like Arya says, in terms of culture. So thanks for highlighting that for us.
Let me, if I can, just make one point in closing on that, Daryl. When we started off our research, you know, we were focusing on the cost aspect of this. And that was particularly important to EXP. The fact that we were able to save money meant that their EBITDA was higher. But if you look at that, you know, founders' wealth creation formula, the most sensitive term is not the expenses and it's not the EBITDA. It's the percentage of the equity that's held by the founders at exit. You know, you vary that number up and down a little bit and watch the impact on the amount that the founders keep. So it's the ability to bootstrap, grow without having to raise very many funds. It's you know, it's keeping the financing low and keeping the founders' ownership percentage high. That has the biggest impact. And that's one of the biggest advantages of a virtual company is its ability to scale without lots of financing and keeping the founders very well endowed with equity.
Good. All right. Well, join me, everybody, in thanking David. Thank you so much. We really appreciate it. We'll definitely keep in touch. I put your contact details in the chat. Basically, we're going to take a 10-minute break. We'll come back